There is a financial strategy so powerful that the 400 richest people in America use it every single day. It costs almost nothing to understand. It requires no illegal activity, no offshore accounts, no Swiss vaults, and yet it allows billionaires to live on billions of dollars without ever reporting a single dollar of taxable income. They buy everything, they sell nothing, and when the tax bill should arrive, it never does, because on paper they do not own anything. The bank account is not in their name, the house is not in their name. The yacht, the jet, the portfolio worth 11 figures, none of it traces back to a social security number. And the IRS cannot tax what does not officially exist. This is not a glitch, this is architecture. And it was designed over a century ago by the same families who now sit on the boards of the institutions that write your tax code. The strategy has a name. Insiders call it buy, borrow, die. 3 words, 3 steps. And a tax savings estimated at over $160 billion per year in the United States alone. Exposed by a 2021 investigation by ProPublica using leaked IRS data, the 25 richest Americans paid a true tax rate of just 3.4% between 2014 and 2018. Meanwhile, a schoolteacher earning $55,000 a year pays an effective rate 4 to 5 times higher. The system is not broken. It was built this way. And what cannot be taxed cannot be controlled. Welcome to the Invisible Ledger. If these stories matter to you, hit subscribe and the bell. This is where we trace the money they told you not to follow. Let us start at the beginning. Not the beginning of wealth, but the beginning of the structure that protects it. In 1913, the United States ratified the 16th Amendment, granting Congress the power to levy an income tax. The word that mattered most in that amendment was income. Not wealth, not assets, not ownership, income. And the wealthiest families in America read that single word and understood something that would take the rest of the country 100 years to figure out. If you never sell, you never earn. If you never earn, you never owe. This was not theory. The Rockefellers practiced it. The Mellons refined it. The DuPonts institutionalized it. By the 1920s, the largest family fortunes in the country were already migrating into holding structures, trusts, and corporate shells. Not to hide money. Hiding money is crude. They restructured ownership so that the money was technically not theirs at all. A holding company is breathtakingly simple. You create a legal entity, a corporation, or a limited liability company. You transfer your assets into it. Stocks, real estate, businesses, art. Now those assets belong to the entity, not to you. You control the entity. You make every decision. You benefit from every dollar it generates. But legally, you do not own the assets. The entity does. And entities do not pay income tax the same way individuals do. In many structures, they do not pay it at all until money is distributed. And the trick is that money is never distributed. Here is where it becomes elegant. Let us say you are worth $10 billion. Your stock portfolio appreciates by $1 billion this year. If you sold shares to fund your lifestyle, you would owe long-term capital gains tax, roughly 20% federally, plus state taxes, plus the 3.8% net investment income tax. On $1 billion, that is nearly $240 million owed to the government. But you do not sell. You call your private bank, Goldman Sachs, JP Morgan, Morgan Stanley, and you say 4 words: I need a loan. The bank looks at your portfolio, $10 billion in blue chip stocks. They offer you a line of credit at an interest rate between 2 and 4%. You borrow $500 million. You use it to buy a new estate, fund a foundation, acquire a company, or simply live. That $500 million is not income. It is debt. And debt is not taxable. Read that again. Debt is not taxable. This is not an opinion. This is Section 61 of the Internal Revenue Code. Borrowed money does not constitute gross income because there is an obligation to repay. The IRS has upheld this principle for over 80 years. You now have $500 million in your hand, and your tax bill is 0. The interest on the loan, say $15 million a year at 3%, is often deductible against other income or structured through the holding company as a business expense. You are being paid, in tax terms, to borrow money you already have. This is the first word: buy. You buy assets. You hold them. They appreciate. You never trigger a taxable event. The second word is borrow. Instead of selling, you pledge assets as collateral and take loans. These are called securities backed lines of credit, or SBLOCs. They are offered by every major private bank in the world. According to the Financial Industry Regulatory Authority, these credit lines have grown into a market worth hundreds of billions of dollars. The terms are extraordinary. A billionaire borrowing against a diversified portfolio of publicly traded stock might get rates below the prime rate. And because the collateral is liquid, the bank faces minimal risk. It is the safest loan they will ever make. And for the borrower, it is the cheapest money on earth, money that is never taxed. But what happens when the loan comes due? This is where the third word arrives. And it is the darkest word in the sequence. Die. When you die, something remarkable happens under current United States tax law. Your heirs receive your assets not at the price you originally paid for them, but at their current market value. This is called the stepped-up basis, and it is codified in Section 1014 of the Internal Revenue Code. Let me explain what this means with real numbers. Suppose you bought stock in 1985 for $10 million. By the time you die in 2025, that stock is worth $1 billion. The unrealized gain is $990 million. If you had sold it during your lifetime, you would owe roughly $200 million in capital gains taxes. But you did not sell, you borrowed against it. And when you die, your heirs inherit the stock at its current value of $1 billion. The $990 million gain is erased, eliminated. The IRS will never collect a single dollar on it. Your heirs can then sell the stock immediately and owe nothing. Or better yet, they do not sell either. They borrow against it. And the cycle begins again. Buy, borrow, die, repeat. Generation after generation. This is not a loophole discovered by accident. It is the tax code functioning exactly as the most powerful lobbying groups in America designed it to function. Before I go further, this video is just the surface. I've collected everything they buried into one place. Inside the Invisible Ledger vault, you will find the complete breakdown of holding company structures, SB lock lending mechanics, stepped-up basis strategies, trust formation guides, and the exposed IRS data that started the investigation. Exposed documents. Exposed, 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 real, exposed, 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 exposed. The link is in the description, but stay right here, because what comes next is how they protect it. Now let me show you how deep the architecture goes. A billionaire does not simply create one holding company. They create layers. The typical ultra-high net worth structure looks something like this. At the top sits a dynasty trust, often established in a state with no state income tax and favorable trust laws like South Dakota, Nevada, or Wyoming. South Dakota in particular has become the domestic equivalent of the Cayman Islands. A 2021 investigation by the International Consortium of Investigative Journalists revealed that South Dakota trusts held over $360 billion in assets, many from some of the wealthiest families on earth. Below the dynasty trust sit one or more holding companies, often structured as LLCs, taxed as disregarded entities or S corporations. These hold the investment portfolios, real estate and business interests. Below those sit operating companies, subsidiaries, and special purpose vehicles. Each layer serves a purpose: asset protection, liability separation, tax deferral, estate planning, and privacy. Because in most states, the ownership of an LLC is not public record. You cannot look up who owns the entity. The billionaire's name appears nowhere. When ProPublica obtained 25 years of IRS data in 2021, the numbers were staggering. Jeff Bezos, whose wealth grew by $99 billion between 2014 and 2018, reported a total of $4.2 billion in income and paid approximately $973 million in taxes. His true tax rate, measured against wealth growth, was approximately 0.98%. Warren Buffett, whose wealth grew by $24.3 billion over the same period, paid approximately $23.7 million in taxes. A true rate of 0.10%. Elon Musk paid a true tax rate of 3.27%. These are not estimates. These are calculations based on actual IRS records. The system has defenders. They argue that unrealized gains are not income, that taxing wealth before it is sold would be unconstitutional, that these structures create jobs and fund innovation. But here is what they do not say. The interest deduction on borrowed money effectively means the government subsidizes billionaire consumption. When a billionaire borrows $500 million against stock and deducts the interest, the Treasury loses revenue. That lost revenue is made up by taxing wages, the income source that cannot hide behind a holding company. If you have made it this far, you already know more about billionaire tax architecture than 99% of taxpayers in this country. Subscribe and share this video. Every share pulls back one more layer of the structure. According to economists Emmanuel Saez and Gabriel Zucman at the University of California, Berkeley, the effective tax rate on the top 400 wealthiest Americans has fallen from 70% in 1950 to approximately 23% today when measured by traditional income metrics, and to single digits when measured against total wealth growth. Their research, published in The Triumph of Injustice, shows that for the first time in American history, billionaires pay a lower effective tax rate than the working class. And the infrastructure that enables this is not hidden on a tropical island. It is in Sioux Falls, South Dakota. It is in Wilmington, Delaware. It is in Reno, Nevada. Trust companies in these states manage trillions of dollars in assets. They advertise asset protection, dynasty planning, and directed trusts that can last for 1,000 years. 1,000 years. Your tax code allows a family to shield wealth from taxation for a millennium. The federal estate tax, which was supposed to be the backstop, the mechanism that ensured wealth was redistributed at least once per generation, has been systematically gutted. The exemption was raised from $600,000 in 1997 to $12.92 million per individual in 2024. A married couple can now pass $25.84 million to their heirs completely tax-free. And with proper trust planning using grantor-retained annuity trusts, intentionally defective grantor trusts, and charitable lead trusts, families routinely pass hundreds of millions and even billions without triggering estate tax at all. The Walton family reportedly used a series of trusts called Jackie O trusts to shelter an estimated $30 billion from estate taxes. Now let me tell you what you can actually use from this, because you do not need $10 billion to apply these principles. Step 1. Understand the difference between income and wealth. Income is taxed. Appreciation is not until you sell. If you own assets that grow in value, the longer you hold them, the more you defer. Step 2. Learn what a holding company is and how it works in your state. In many states, forming an LLC costs between $50 and $500. An LLC can own investments, real estate, and business interests while providing liability protection and tax flexibility. Step 3. Understand securities-backed lines of credit. These are not only for billionaires. Many brokerage firms offer portfolio lines of credit to investors with accounts as small as $100,000. Interactive Brokers, Schwab, and Fidelity all offer margin or pledged asset lending. The interest rates are often lower than a home equity line. Step 4. Study the stepped-up basis. If you plan to leave assets to heirs, understanding Section 1014 can save your family enormous sums. Assets held until death reset their cost basis. This is one of the most powerful wealth transfer tools in the tax code. Step 5. Consult a tax professional. The strategies described in this video are legal, but they require proper structuring. A qualified CPA or tax attorney can help you implement them correctly. The total cost of understanding the system is zero. The total cost of ignoring it is everything you will overpay in taxes for the rest of your life. I need to be honest with you. This is not a magic trick that eliminates all taxes overnight. First, borrowing against assets carries risk. If the market drops significantly, your collateral loses value, and the bank can issue a margin call, forcing you to sell at the worst possible time. Second, the stepped-up basis is under political threat. The Biden administration proposed eliminating it in 2021, and future administrations may try again. Third, setting up holding companies and trusts requires legal expertise. Doing it incorrectly can trigger IRS scrutiny, penalties, or loss of asset protection. Fourth, these strategies work best for people who hold appreciating assets long term. If you need to liquidate frequently, the borrow strategy becomes less effective. And fifth, there's a moral dimension that this video does not resolve. Whether it is right that the tax code favors wealth over labor is a question for democracy, not for accounting. But the system exists, and pretending it does not will not make your tax bill smaller. Your great-grandparents understood something that 2 generations forgot. Wealth is not what you earn, it is what you keep. For thousands of years, families built across generations passing knowledge, land, and structure from parent to child. Then, somewhere in the 20th century, the middle class was taught to earn, spend, and earn more, to measure success by salary, not by sovereignty. The billionaires never learned that lesson. They kept the old playbook. They just rewrote the rules so no one else could read it. There was never a better system. There was just one system for them and a different one for you, until now. Subscribe and share this video. Every share pulls back another layer of what they built in silence. The next vault opens soon, and what is inside will explain why the IRS audits the poor 5 times more often than the rich, and exactly who made sure it stays that way. Z6.